Welcome back to class, you double OG to the beat don't stop till you get enough shoddy, boy. In today's class, we're going to talk about assets versus liabilities, how to distinguish one between the other. And for most of the video, we're going to actually do it on the computer because I know I would prefer to show you guys visuals, that way you guys can see the information and grasp it better. But without further ado, let's go ahead and get into the video. So let's get right into today's lesson, which is going to be assets versus liabilities. What is an asset? The textbook definition of an asset is properties owned by a person or company regarded as having value and available to meet debts, commitments, or legacies. That's kind of hard to understand, kind of hard to wrap your head around it. Honestly, I find it hard to... Reading the definition, I don't really know what an asset is, to be honest. So I like to go based on the definition that Robert Kiyosaki goes by. I did read the book Rich Dad Poor Dad, so I highly recommend people that haven't read that book to read it. It's very educational when it comes to cash flow and pretty much anything to start off financial literacy. So his definition of an asset is an asset puts money in my pocket. It's as simple as that. Money goes into your pocket. It's that easy. I went ahead and also provided a diagram so you guys can see a visual of money going into someone's pocket, because that's pretty much an asset is. That's all it's supposed to do. Okay, so let's go to the next slide. These are just some examples of how to invest in assets. The first one would be, and I feel like this is the easiest one to do, it would be to invest your money into the stock market in the way of either buying stocks, individual stocks, buy them low and sell high. Buying dividend yielding stocks, which I will actually go into more in depth. I'm going to make a whole video about that. CDs, bonds, index funds, mutual funds, ETFs, real estate, investment trusts, also known as REITs. All of these examples, I'm actually going to make separate videos on them, which I will go into more details about them. But these are assets because they are all going to be giving you back money. They're going to put money into your pocket, which is what an asset does. Another way to invest in assets would be to buy rental homes, and I'll actually talk about more on this later on this video. Another one would be to create your own product and have that one right on top of investing yourself, because I feel like they go together. I'm investing in myself right now by learning all this and teaching you guys through YouTube. So I'm trying to brand myself. That's pretty much how those two coincide. But you can pretty much make anything. You can, make cookies and sell them. You can make shirts, sell them, anything, hats, whatever. The sky's the limit. Your imagination, as long as you can think about it, just go ahead and do it. You can also put your money in a high yield savings account, but just leaving your money in there, wherever you put your money, it is going to be giving you back interest, positive interest, so that's good. And there's also something called peer-to-peer lending, and if you guys don't know what that is, I'm going to explain a little bit on what it is right now. So peer-to-peer lending is kind of what it sounds like. You pretty much skip the middleman, and it's just someone lending, a person, an individual, lending money to someone else. And lastly, another way to invest into an asset would be to open up a business, and I went ahead and gave some examples on that right there. So now we're going to go into what a liability is. The textbook definition of a liability is the state of being responsible for something, especially by law. And that really doesn't explain to me what liability is. So once again, I like the definition that Robert Kiyosaki did, and it's the one that I actually go by, and that's liabilities take money out of my pocket. So anything that takes money out of your pocket is considered a liability. And on the diagram that you can see that money is going into the trash, pretty much is money going away. So here are some type of liabilities. The first one would be a personal residence, the home you live in, and I'll go into more on why this is a liability later on in this video. Another thing would be a car or anything with a motor. Now, why is a car a liability and not an asset? It's really simple. That's because anything with a motor, over time, it will cost money to repair. A car needs gas to run. That's a liability because it's taking money out of your pocket. It needs maintenance, it needs all of this. And in the future, the car is going to cost less if you sell it. For all of these reasons, a car is a liability and not an asset because it costs money to run and to maintain. So anything with a motor is considered a liability. That includes boats, RVs, motorcycles, cars, for the reasons that I mentioned before. And credit cards are a liability paying taxes, any type of loan, and just in short, anything that takes money out of your pocket is a liability, alright? Plain and simple. So now we're gonna get into the debate why a house is an asset or a liability. A lot of people think that a house is always just an asset and never a liability, and we're actually gonna break down the reasons why I think, remember this is just my opinion, of why a house could be an asset and why it could be a liability. So when is a house actually an asset? A house is an asset when someone else is living in your property and is paying down your liability, aka your mortgage. So as long as you're not paying the mortgage down, that's when it's actually an asset. So for example, if you buy a duplex, you can live in one and rent out the other one, and the rent that you're charging the other person, you can use that money to pay off your mortgage, so you're basically living there for free. And that's when it's an asset. Or if you're currently living in your house already, it's a liability because you're the one paying down your mortgage. If that's the case and you want to turn your liability into an asset, it's really as simple as renting out some of the rooms in your house and using that rent to pay off your mortgage. Or you can fix up your garage or something, use Airbnb to rent out the spots. All the money you're getting from that, you can use it to pay off your mortgage because you're not the one paying it. Remember, anything that's putting money in your pocket, renting, is an asset. If you're the one paying off your mortgage, is taking money out of your pocket, that's when it's a liability. And another way that a house can be an asset is if you were to buy it and once you sell it, the profit that you make of it, that's when it's an asset because you made money off of it. If you were to buy a rundown home and you fix it, fix her up, you sell that, that's when it's an asset as well. As long as it's putting money into your pocket, then it's an asset. Okay, now let's talk about why and when a house is a liability. So a house is a liability because it takes cash flow away from you until you finish paying off the mortgage. So what does that mean? I'll give you an example. If you have a mortgage of, let's say, $2,000, right, a month, those $2,000 that you're paying for your mortgage, well, one, is taking money out of your pocket, so that's a liability. And two, those $2,000 that you're paying down your own mortgage, you could have used it and invested it in something else that would have given you a return. You could have put it in an actual asset that would have given money back to you. So the first and second bullet point kind of correspond to each other, and that's when you're the one paying off the mortgage for the same reason that I mentioned before. So now this is a debate that I would say a lot of people, remember this is just my opinion, but a lot of people would say that their house is an asset once they're done paying it off because they're not paying a mortgage, right? But you guys have to remember that if that's the case, you're still paying your mortgage insurance, you're still paying for maintenance, for property tax, so you still have expenses. So those are expenses. It's a liability because it's money taken out of your pocket. If you don't have someone paying that for you, it's a liability. Remember, this is just my opinion. The only time you would actually make any money out of the property that you're living in is when you actually sell the house. If you bought the house for, let's say, $600,000 and they're offering you $700,000, that's $100,000 profit. That's money you haven't made because you haven't sold the house. It's only an actual profit when you physically sell the house and they give you the money. But until then, your house is not an asset because it hasn't given you any money back. Okay, and just remember, a house for you is not a money generating asset. It's that simple. So now we're going to talk about a scenario, right? Person 1 and person 2. Both of these people have $25,000 that they can spend on a car. That's going to be the scenario for today. Person 1 buys a brand new 2020 Honda Accord for $25,000. How much money do they have left? It's zero, right? Because they spent all their money on buying that car cash. Okay, that's good. Now, person number 2, on the other hand, bought a used 2014 Honda Accord cash for only $15,000. So they have a remaining balance of $10,000 that they can do whatever they want with it. Let's say that person would invest in an index fund that's giving them an 8% rate of return. I went ahead and did research, and it showed that the average rate of return is actually on an index fund is 10 to 11%. So I went a little bit moderate and just showed an 8% for this example. So person number 1 bought a car, cash, has no more money left. Person number 2 bought a used car, had $10,000 remaining, and invest in the remaining, right? Now before we go into more of this example, and before hopefully you guys haven't read the rest of the bullet points, this is an example of why assets are so important and why you should invest in assets rather than liabilities. So now, let's say 10 years have passed. Person number 1, a car that was worth $25,000 after 10 years is now worth $7,400 due to depreciation. Yes, I looked this up, and I'll actually put the information of where I got this on the description down below so you guys can see for yourself. And what I did to get these numbers after was I actually went on Car Gurus, and I went to see how much 2010 Accord would cost, because that's a 10-year difference, right? And it was roughly around the same price. Now person number 1, after 10 years with those $25,000 that they used to pay off their car cash, lost $17,600 in the car's depreciation. Now let's go ahead and look at person number 2. Person number 2 car lost $9,000 in depreciation. That car after 10 years is actually worth $6,000 now. And yes, I did the same research that I did for the first one. I went up to, I googled like honest depreciation, right? Go ahead and put the link down below. And then I believe I did a 2,400 quarter price on Car Gurus, and it gave me roughly around the same price. Now the difference is because this person did buy a cheaper car and invested the rest. Remember that they invested $10,000 for 10 years in an index fund. That index fund, their portfolio grew from $10,000 initial deposit to $21,589 with $25 cents, after the 10 years. So now, person number 2, from the $10,000 initial deposit into the index fund, made a profit of $11,589 with 25 cents. Now, so the reason I did this scenario was, like I mentioned before, to show you guys the power of investing into assets, because it's gonna put money into your pocket rather than take money out. I really hope this video was informative, that you guys learned a little something. If you did, please go ahead and play heads up 7 up with the like button. I really do appreciate it. Any feedback that you guys would like to give me, comments, I would appreciate it. Go ahead and comment down below with questions that you have, and I'd be happy to answer them down there as well. Remember, this was all educational. This is not financial advice. It's just me trying to have fun, trying to show you guys something that I do know. I am not a licensed professional. So do your due diligence and look up these topics on your own time so you guys know better. I really hope that by watching this video you guys learn the difference between an asset and liability. And just to reiterate, an asset puts money into your pocket, a liability takes money out of your pocket. You guys can do a list of what you guys have and decide if you guys have any assets, and if you don't, go ahead and look at the asset list that I did, so you guys can actually learn and do research on your own, so you guys can start investing into assets. And if you guys have a lot of liabilities, please just make sure you guys pay them down as soon as possible so you have less of them, so you can start investing into assets. I really hope you guys enjoyed this video. Remember, go ahead and play heads up 7 up with the like button. I really hope you guys comment, go ahead and give me feedback. I really want to engage with you guys. So far I've only gotten a few comments here and there, and I do reply to all of them, if they're topic related based comments. So I think I'm gonna start making the videos from this angle, because I feel like I'm closer to you guys. That way we actually make this bond, hopefully by doing this you guys actually play heads up 7 up with the like button, share, subscribe, comment down below. That's my goal. But I don't want to take any more of your time, so I'm gonna go ahead and end the video with today's bar of the day. And it's gonna be for every flexer out there. You know who you are. And this bar is by MGK, chains and whips without the slaves. Now give me some chips so I can dip.